Hood is sitting on the $70 support zone for the second week in a row. The weekly chart is fully oversold. Options are stacked at 75 on both sides, and this all matters heading into this week. So let me ask you right now, is 70 actually the floor? Or are bulls about to get dipped again? Welcome back to Fintech Spy, where we don't just watch volatility, we interrogate it. I am not a financial advisor. This is not financial advice. And if you're making portfolio decisions based on a parody news desk, we need to have a serious conversation. Let's get into it. Quick housekeeping before we break down the tape. I missed the midweek review because I caught that nasty head cold that's been going around, the kind that turns your brain into a spinning loading icon and makes every red candle feel personal. So if you were wondering where the midweek panic check went, it was me. I was the panic check. But it actually raised a bigger question. Do we even keep doing the midweek review? Or do we pivot into something more useful, like periodically revisiting the news drops and asking, did it actually matter? Because sometimes we get a headline, the chart twitches for 12 minutes, and then everyone forgets it ever happened. Other times, something quiet ends up being the real catalyst. So drop it in the comments. Keep the midweek review, or switch to the Did It Matter revisit format? Now, Hood specifically. Earnings wasn't a triple beat. In fact, revenue missed, and the street got hesitant. We finally received December monthly metrics, but January's still missing. And when data shows up late, whether it's innocent or strategic, markets get suspicious. Then a Form 4 hits. Former CFO sells 125,000 shares at $85. He still holds over 400,000 shares, so it's not an exit, but optics matter. Meanwhile, Cathie Wood shows up with a large buy. I'm sure she's holding it forever. Absolutely. No chance she rotates before we know. So that's the setup. Mixed fundamentals, mixed signals, insider selling, Cathie buying, analysts still bullish, and the chart sitting at support. Since earnings, we've had 10 reiterations. 10. One upgrade from Wolf Research to buy, and one assigned buy at $100. The average target now sits at 128.62, with a max target of 181. Current price? 76. If Hood runs from here to 181, I will personally frame that analyst note and hang it in my office. This is that awkward disconnect where analysts are modeling upside, but price is modeling caution. Historically, when targets stay elevated while price compresses, one of two things happens. Either the analysts slowly walk those targets down, or price eventually walks up to meet them. Right now, I lean slightly toward price stabilizing first, but it needs proof. On the weekly time frame, Hood is sitting right on the 77.10 Fibonacci level, and more importantly, it has bounced off the 70-60 range for the second week in a row. That's not random. Double bounces at known support can become the foundation of a base, but only if buyers follow through. The stock RSI is completely oversold, not mildly tired, buried. That doesn't guarantee a rally, but it does mean downside momentum is exhausted. MACD is still negative, but it's drifting toward neutral. That's deceleration, and deceleration at support is exactly how selling pressure fades. The 50 EMA sits up near 95.65 and is still trending downward, so bulls have work to do. But if 70 holds again this week, this starts to look less like a falling knife and more like structural support forming. This isn't explosive, but it is constructive. Now zoom into the daily. MACD has been deeply negative throughout the week, but here's the key. It's flattening. Not ripping higher yet, just flattening. And flattening momentum is step one in a reversal process. The stock RSI was oversold and is now climbing toward neutral. That's buyers testing the waters. Meanwhile, the 50 EMA is sliding down toward the 200 EMA. They're getting close. When moving averages compress after a decline, the market is approaching a decision point. The 50 and 100 EMAs remain crossed bearishly, yes. But if price stabilizes here, that compression becomes potential fuel. This doesn't scream breakout, but it also doesn't scream collapse. It screams prove it. Options corner, expiration February 20th. Expected move plus or minus 6.72. Current price 76.07. Largest put open interest sits at 75 with 5.6 thousand contracts, followed by 80 with 5.0 thousand. Largest call open interest is also 75, with 8.8 thousand contracts, then 80 with 7.6 thousand. That's not subtle. Both sides are stacked at 75. That level isn't just a price, It's a battlefield. Calls slightly outweigh puts there, which gives a mild bullish lean. But more importantly, this looks like classic pin risk territory. If price hovers around 75 into expiration, a lot of premium quietly evaporates. What are traders expecting? Movement, but not conviction. Nobody is screaming collapse. Nobody is screaming moon. They're positioning around support, and that matters. Outlook. If 70 breaks with conviction, the bullish thesis weakens quickly. But if 70 holds for a third week and momentum continues flattening, this becomes legitimate base building behavior. Oversold weekly double bounce at support, options positioned at 75, analysts still modeling upside. This is how bottoms begin, quietly, skeptically, unconvincingly. So I'll ask you again, is 70 the floor? Or are we about to dip the buyer one more time? Drop it below. If you enjoy high-quality over-analysis and emotionally stable sarcasm, hit the like button and subscribe. We'll keep watching hoods so you don't have to stare at your P&L alone. Remember, this is parody. This is not financial advice, and the only guarantee here is commentary. And as always, the only thing more volatile than hood is trader confidence. See you next time.